Good morning, all my friends. And today there is a second session of economics, 8A, CA Intermediate. Uh, we have Vijay sir over here. So, sir, shall we start?
Yeah.
Yes.
Good morning, friends. So, in the last class, we have started discussing chapter 2. So, fiscal policy. So, in that, we started with fiscal function. Fiscal function, which is nothing but public finance. That is the role of government in economic system. Why there is a need for government to overcome the market failure. Sir, why there is a market failure? Market failure, the major reasons for market failure, which is due to market power, externality, public goods, and incomplete information. Now, so we identify the reason for the market failure. Now, government need to take measures to overcome this market failure. Now, with respect to market power, so monopoly is an issue. So the government came out with a competition act to restrict the monopoly. Then, sir, price regulation. Sir, wherever the monopoly is keeping a high price, then that need to be regulated. Predatory pricing. Okay, that need to be controlled. So, underpricing as well as overpricing need to be controlled by the government. Okay, on account of market power. Then externalities. So this is what the government intervention. As a supplier, okay, government will supply the public goods. So public goods are common goods which is used by all, and also as a government need to give the proper information, because yesterday we discussed that incomplete information is an one of the reason for market failure. As a buyer, okay, government will procure goods on behalf of consumer, and they will sell the goods like a fair price shop, ration shop, supply of goods through ration shop. Okay, then taxes and subsidies to alter the cost. That is, for example, sir, there is a negative externality. Then pollution tax will be levied by the government to reduce the production. Sir, when there is a positive externality, government will give the subsidy to reduce the cost, so that private players can produce more goods and to supply the goods to the extent of demand. Then as a regulatory, regulations are in place, policies are in place to control market failure, like the competition act, all those things. So minimize market power, prevent excess price, quality of service, promote competition, natural monopoly may be maintained. So action of government to minimize market power, regulating prices, liberalization of market, that is, there should not be any entry barrier. Okay, anywhere free entry and exit need to be there. Okay, and there need to be a proper merger policy. Okay, that should not, a merger policy will not end up in monopoly. Okay, then there need to be a competition act should be in place, because the company should not, the private company should not enter into cartel. That is, they will form a group, okay, and creating monopoly. All those things need to be avoided. Then correct externalities. The next issue is what? Externality. So direct control will be one measure to correct negative externality. Then the market based policy. Direct control, okay, is what sir, I am going to ban that goods. For example, banning, okay, plastic bags, okay, will be the direct control. Sir, market based policy, I can't okay, stop the production, but instead of that I can reduce the production by way of levying taxes, okay, and sorry, or I can, okay, incentivize the reduction of pollution. That is, this is the, okay, maximum pollution which you can make if you produce the goods at a lesser pollution. Then you will get a, okay, incentive. Suppose a person who is producing goods at a higher pollution, okay, then they need to, okay, pay more for that. So that is what a market based policy. So this is what direct. Okay, first you ban the goods. No sir, I can't ban the goods. Okay, but I need to control production. Then in that case, okay, you levy tax. You levy tax. So now tax will form part of the cost. When cost increases, price increases. When price increases, demand decreases. When demand decreases, supply will decrease. See, decrease in supply, which is a reduction in production. So at least, sir, when production reduces, consumption will also reduces. Pollution will reduce. Here, this is what marginal social benefit, and this is going to be a marginal private benefit also. But this is what the marginal private cost, intersection point. This is the price and this is the quantity produced. Now what happened? My private cost plus tax, pollution tax, which I make the externality into the market price. Then in that case, my cost will reduce, my cost will increases. Okay, this increased cost, which shift my, okay, supply curve leftward, because there is a reduction in, okay, production. This reduction in production, okay, which decrease the quantity supplied as well as increase the price. This pollution tax, which is introduced by AC Pigu, an economist, this pollution tax, which is also called as Pigivian tax. Then tradable emission permit. This is what I will say, it is also known as cap and trade method. Sir, here I will fix the pollution limit. If the pollution limit is beyond this level, okay, then they need to, okay, get the tradable emission permit from the person, okay, who is not polluting. So like that, carbon credit. Have you heard about carbon credit? Carbon credit is an incentive which will be availed by a person who is okay, producing uh, less pollution. So they will get the money by selling that credit. Credit is nothing but the reward point. Okay, they will sell this reward point a person who is polluting more. ஒருத்தன் கம்மியா பண்ணியிருப்பான், ஒருத்தன் அதிகமா பண்ணியிருப்பான். அதிகமா பண்ணவன் கம்மியா பொல்யூஷன் பண்றவங்க கிட்ட இருந்து அந்த கிரெடிட்டை எடுத்துப்பான். அந்த கிரெடிட்கான பேமெண்ட் பண்ணிடுவான். Okay, this is what we call it as tradable emission permit. So problem in administrating an efficient pollution tax, right level of tax, okay, monitoring polluters, okay, which is very difficult, okay, no genuine solution. See, only if you ban the goods, okay, you can, that will be a solution. But the living tax, again, okay, this tax burden will be shifted on to the consumer. So if consumer ready to pay more price, suppose the product has the inelastic demand, okay, then the seller will not worry about the pollution tax. He will keep on produce the tax, he will keep on produce the goods, okay, pollution tax will increase, that will be shifted on to the consumer. And sir, too much of pollution tax which discourage the employment and investment. So in case of tradable emission permit, that is the cap and trade, okay, here the advantages are the system allow flexibility, reward efficiency, okay, it is administratively cheap and simple to implement, okay, because it is market driven and pollution is minimized in the most cost effective way, and also you are incentivize the, okay, producer who are polluting less. It also provide a strong incentive for innovation. Consumer may benefit if extra profit made by low pollution firms are passed on to them in the form of lower price. Suppose a person who is producing less pollution, okay, since their cost will reduce, that will be shifted on to the consumer, so price will what happen, reduces. Once again, friends. So in case of positive externalities, okay, government may incentivize the producer to produce merit goods, that is, which are having positive externality. If the private enterprises are not willing to do that, then government on its own, they can directly produce the goods and provide them to the consumer. Merit goods. Okay, merit goods. These goods are having higher positive externalities. Example: education, health. See, this will be this we call it as socially desirable goods. This will be left to the market. Okay, if market are quoting higher price for this goods, for example, sir, where the poor people are not affordable for getting education, the government need to provide. When poor people are not affordable for hospital facility, then that need to be provided by the government. So here what happened, the private cost will be more than social cost. Why? Because the positive externality which reduce the cost. So instead of producing Q, I am able to produce Q dash. So underproduction can be avoided. See, reasons for government provision of merit goods: information failure, equity consideration, lot of uncertainty. Consumption of merit goods at zero price. See, at zero, there will be a limited quality. Okay, when price is not there, then demand will increases. So my supply will be limited, but whereas demand will what happen? Increases. Demerit goods. Demerit goods are goods which are believed to be socially undesirable, anti-social goods like cigarette, liquor. So private cost will be or less than the social cost. Why? Because negative externality will be there that need to be added to the social cost. So I need to completely ban that goods. Okay, or negative advertising. Okay, prohibit promotion. Okay, regulations to limit access, regulatory controls need to be there to control the demerit goods. Government will fix the higher price for the demerit goods in order to reduce the consumption. So they will fix the price, higher price. So as we know that the characteristics of public goods, yesterday we have discussed, there is no direct payment by consumer is involved in case of pure public goods. Public goods is non-driverless. Okay, that is there is no competition, there is no payment, so anyone can use that goods, non-excludable. There won't be additional cost, indivisibility, vulnerable to free rider problem. So I need to make see, in order to overcome this free rider problem, okay, I need to fix the price for the public goods, like the toll charges for using the roads, or uh, the government may give the contract to the private person to operate. We call it as a BOT, build, operate and transfer. Okay, contract. Okay, which we, sir, you lay the road. L&T will lay the road. Okay, will maintain the road for a particular period of time, and they will collect charges. So public goods facility will be given to the private enterprises by way of giving license, and the fees will be collected, so that okay, uh, we can avoid the free rider problem. Government will enter into a okay market by way of fixing the price intervention. Normally price will be fixed by the market, okay, based on demand and supply. But wherever the government need to enter into the market to fix the price, okay, then they will do it, like minimum wages, rent control, minimum support price. Sir, price floor, minimum price the buyer are required to pay. For example, the market price is what 100 rupees, but all the people are not affordable to pay 100 rupees. For example, tomato, then the government have supplied a tomato to through fair price shop or ration shop at a price of 50 rupees. That is what we call it as price floor. Price ceiling, a maximum price seller are allowed to charge for a good or services. Sir, this is the minimum support price or minimum wages. Sorry. So the minimum maximum price the seller are allowed to charge for goods or services will be a price ceiling. Correcting information failure, accurate labeling, subsidizing of incentives, regulation of advertisement. Okay, there need to be a proper labeling. Okay, proper information need to be given. Okay, and regulation of advertisement. False advertisement or adverse advertisement need to be avoided. Equitable distribution, because inequality is also the one of the reason for market failure, because only the rich people are having money. Okay, and even the rich people can demand goods to some extent only. So the more than a spending, rich people will have the savings. Okay, as we know that if more savings, then national income multiplier will what happen? Reduces. And the poor people are not having money, they can't demand the goods. So if consumption reduces, automatically national income will reduces. So I need to put the money in the hands of the public. So for that, there need to be a equitable distribution. Okay, government need to give allowances, incentives, subsidies, and progressive taxation. Related rich people pay more tax, by which okay, you can achieve the equity and fairness in the society. Government also intervene to black economy, that is the black market, where the unaccounted money are there. Okay, that need to be channelized okay, through banks. So government failure occur when intervention is ineffective, causing wastage of resources. Okay, see, the government failure, okay, will also be there on account of too much of intervention into the market. That also need to be avoided. So fiscal policy, Chapter 2, Unit 4. Sir, fiscal policy objective is to use the tools of fiscal policy, okay, or the instruments of fiscal policy. 4 instruments: government expenditure, government receipts, which is in the form of tax, then the government borrowings. All this will be presented in a statement called as budget. By using these 4 tools, government need to achieve the full employment, that is the economic growth and development. So economic growth, equitable distribution of wealth and income, reduction in poverty, price stability, exchange rate stability, full employment. Okay, these are all the objectives of the fiscal policy. So here discretionary fiscal policy, non-discretionary fiscal policy. Sir, discretionary fiscal policy where the government deliberately policy actions are taken to, for example, to reduce the government expenditure or to increase the government expenditure, tax rate, in order to influence the level of national income, employment, prices. Where the government is deliberately doing this. In case of non-discretionary fiscal policy, or which is also called as automatic stabilizer, sir, this will have the built-in fiscal mechanism, okay, which automatically changes with change in business cycle. Sir, for example, when the economy is in expansion phase, you all know that 4 phases of business cycle: expansion, peak, recession, trough, that is we call it as depression. Now, during expansion, income increases. When there is a progressive taxation, the consumer, okay, the individual will pay more tax. Okay, and since the people are having more income, there won't be any unemployment allowance. There will be a reduction in unemployment allowance. Okay, so this will happen in case of expansion phase. When there is a recession, okay, people are not having money, then the government will provide allowance. So that is what we call it as transfer payment. So the government will provide okay money as allowance, which has been transferred from government account to what public account. Transfer payment. Okay, then sir, this slab rate, what happened when income decreases, automatically you will end up in paying low rate of tax. So this is what we call it as automatic stabilizer. One second. Friends, are you able to see the slides? So during recession, income are reduced with the progressive tax structure. There will be a decline in the proportion of income that is taxed. Okay, and this would result in lower tax payment. Government will increase the transfer payments like unemployment benefits. Okay, this too will increase the disposable income. This disposable income increases, then demand increases, which results in increase in production. Okay, national income increases. During inflation, okay, economy expands, employment increases, people are having more money. Okay, I'm going to levy what higher tax. Okay, and corporate profits are increasing, so corporate tax will also increases. I will not okay provide any allowances since the people are having what money, so government expenditure will falls. So when government expenditure falls, all the tax and the people are having more money, government borrow from the public. Okay, so the excess liquidity will be taken away by government, so that demand will reduces. Okay, when demand reduces, okay, automatically equilibrium point will achieve, the price will be stabilized. Now instruments of fiscal policy. Okay, 4 instrument: government expenditure, tax, public debts, budget. Government expenditure includes current expenditure, capital expenditure, transfer payment. Current expenditure, okay, so which is nothing but a payment of salary to the government employees, repairs and maintenance, all that will be current expenditure. Capital expenditure will be the expenditure incurred for infrastructure development. Then transfer payments, like unemployment allowance, pension, old age pension. Okay, all this will amount to transfer payments. So public spending, that is the public expenditure, will be pump priming or compensatory spending. Pump priming assumes that when private spending becomes deficient, sir, when the private investments are not okay, the private players are not interested to investment in a particular project, or it is not up to the level, then in that case, to the extent of deficiency, the government will incur the expenditure. Compensatory spending, sir, this is also like pump priming. When see, when private are not able to do it, okay, then the government will do it. So during, okay, depression, there will be a pump priming and a compensatory spending expenditure will be there. During, okay, inflation or expansion, okay, this expenditure will be cut down. Tax, in case of recession, okay, tax rate will reduce, so disposable income will increases. When disposable income increases, there will be increase in demand. which results in increase in industrial growth and national income will increases. In case of inflation, okay, there will be a high tax rate which decreases the disposable income, that is which results in decrease in purchasing power, decrease the demand, okay, so that price will reduces. Internal and external debt. Internal debt is what borrowing from the market from our public, okay, through issue of say treasury bills. That is the government will issue their okay short term treasury bills through RBI, by which they will collect okay excess money from the market. So external debt is what the debt borrowed from foreign market. So in case of recession, repayment of loan will be there, so that money will be put in the hands of the public by reducing the deposit rate. In case of inflation, increase the okay bond rate, by which they will collect the money from the public as borrowings, okay, and they will hold it that money, okay, till the demand decreases. So budget, revenue is equal to expenditure, leakage is equal to injection, okay, then the balanced budget. Revenue greater than expenditure or leakage greater than injection, then negative budget, okay, this will happen at the time of inflation. I need to take away the excess money from the economy, either by way of collecting taxes or the borrowing money, by reducing the government expenditure. When all these things happen, then that will amount to surplus budget. Then deficit budget, okay, where I will incur more amount of expenditure, I will put the money in the hands of public, and I will reduce the tax rate, repayment of loans will be there. So there will be a deficit budget. Deficit budget will be prepared at the time of deflation or recession. Expansionary fiscal policy, contractionary fiscal policy. Expansionary fiscal policy, where I will incur okay more amount of government expenditure, okay, that will be followed at the time of recession or depression. Okay, expansionary will be at the time of okay depression or recession. Contractionary will be at the time of inflationary or expansionary. So fiscal policy for long-term, long-run economic growth, as involving infrastructure spending, okay, that will have the positive. See, when infrastructure development is there, then the production will increases, supply will increases. So government will have a adequate provision of public goods, education, research and development. All this will be there. Okay. So well designed tax policy, okay, which encourages the innovation and entrepreneurship, okay, without discouraging the private business who wish to invest, thereby help the economic to grow. Income tax differentiation, that is progressive taxation. Okay, indirect tax differentiation. In case of indirect tax, GST will be levied more on luxurious goods, less on necessity goods. Okay, so all this will amount to reduction of what inequalities. Limitations of the fiscal policy. 4 types of lag. Sir, first of all, uh, policy lag and implementation lag, decision lag, then the last one is impact lag. Sir, first of all, I need to decide what policy to be incorporated. Sir, in order to decide that, okay, I need to know, I need to assess the economic situation. There is a time lag. Once I assess, okay, I need to frame the policy and that need to be implemented. That implementation lag will be there. Okay, once I implement, I need to analyze the impact. Okay, that also takes time. So these are all the 4 types of lag. Okay, so implementation of wrong policy at a wrong time will have a adverse impact. Difficult to reduce public spending. Okay, so it is not easy to reduce public spending because some ongoing infrastructure works will be there, public work will be there. You can't stop that work immediately to implement a fiscal policy. Okay, difficulty of forecasting, conflict of objective. I can't satisfy all. Some person need to suffer. And sir, too much of debt borrowings will have a burden on future generation, then crowding out. Sir, too much of government intervention which results in, okay, crowding out. See, wherever the market is not in a position to do it, market failure which necessitate the role of government. But if the government has started giving free laptop, then the market laptop will not be sold. Okay, which results in crowd out. Government freely distributing the goods. Government increase spending by borrowing. Increase government spending. All these are all the reason for what crowding out. So with this, we have completed chapter 2. Sir, chapter 3, money market. In that, first of all, the concept of money demand. Then unit 2, money supply. Okay, unit 3 is what the monetary policy. So functions of money. Medium of exchange, store of value. So money is used as a medium of exchange, store of value. You can't store the goods for a longer period of time, but you can store the money. The value of money will remain same. Then you can use the money for deferred payment. So these are all the functions of the money. Okay, characteristics of money: generally acceptable, durable or long lasting. Okay, relatively scarce, portable or easily transported, possessing uniformity, divisible into smaller parts. Okay, effortlessly recognizable. To overcome the difficulties of barter system, okay, money has been introduced. Demand for money is a derived demand. Okay, it is derived based on the demand for goods and services. If more goods and services are required, then there will be a more demand for money. Then theories. Demand for money. Sir, need for money is what for purchase of goods and services. Transaction purpose. Transaction purpose. So the volume of money, okay, and the circulation of money, which is based on the price for goods and services paid for the transaction. So that is what money value, that is MV, which is equal to price, average price level, and the total number of transaction. Sir, for example, I am having 100 rupees note. Then that 100 rupees note, okay, I spend for 10 times. Okay, each 100 rupees note I spend once. That means 10 times will be there. Sir, price per good is what? 100 rupees. Then in that case, okay, this 100 into 10, okay, that is the number of transaction made, 10. The amount which I am having is what? 100 rupees. So 10 into 100,000, which is equal to, okay, price per good 100. Okay, how many goods I have purchased? That is the total number of transaction which I made at 10. Okay, this 1000 is equal to 1000. Okay, this is what I will call it as a Fisher's version of equation. okay, equation of exchange of transaction approach, where MV is equal to PT. Okay, this is given by Irving Fisher. Okay, this theory, which is also called as quantity theory of money. Friends, we will have 10 minutes break and then we will start.